Hi, everyone. This is Josh and Jeremy. Looks like we just have a few people starting to sign in, so that's great. Thanks for joining us today. We'll give people until about 11:30 Mountain Time, and we will get started. So glad everybody's here today. A couple of logistical things as we get started. One of those, of course, is we want to make sure that everybody knows how to ask a question. And because for compliance purposes, our compliance auditors say that we need to have those emailed instead of using the GoToWebinar features. And so the way to do that would be to email Jeremy directly at jeremy@keystonefinancial.com, and he will moderate. So yeah, I'll give everybody a couple minutes here. It's 4th of July week, of course, and so a lot of people are off and probably not thinking about money. But nonetheless, for those of you who are here live, certainly glad that you're able to tune in. The other thing is I want to make sure that we acknowledge the people that are watching this after the fact or listening after the fact, because really we have just as many, if not more, on most of our events, whether they be webinars or any other kind of audio stuff that we do try to make that available. Again, we've got some compliance hurdles just because we are maybe not as regulated as the healthcare industry, but I think financial industry is kind of the number two as far as the amount of regulations that we have to follow. So we try to post as much stuff as we can out there, and that's there after the fact as quickly as we can get it out. So this will be available. If it is available, it'll be available on the YouTube channel. Just go to keystonefinancial.com and click on the YouTube link up in the upper right hand corner. So it's 11:29 right now. We'll give people one more minute and then we will get started. So for those of you who are here live, you've got the benefit of asking questions. Anybody who tunes in after the fact, you still have the benefit of the people that were here live, the fact that they ask questions. And it might be stuff that you're already thinking of, but sometimes it's new stuff, right? It's things that maybe didn't even cross your mind before. So again, thanks for attending today, and certainly thank you for those of you who end up watching after the fact. So again, Jeremy at keystonefinancial.com is how to ask a question. And we're not going to have a lot of slides today. We actually just have a couple here at the beginning for compliance purposes. And then the remainder is going to be just us talking and answering questions. So first slide here, I thought it was just kind of funny, so I threw it up here. Forecast 2020, ready for anything. We designed this back actually December and January is when we put this together. And it's kind of funny. We had no idea any of this was going to happen. It's kind of crazy, right? How things have unfolded. And certainly it's not just even coronavirus. That's been the biggest thing probably that's affected the economy. But then you've got a lot of social unrest on top of that. Sorry, I've got construction noise behind me here. This is very real and live, not heavily produced. So hopefully you appreciate that too, that this is just us and what we're really thinking, and kind of what's going on throughout the days. So, but yeah, some crazy stuff really that's happened this year: social unrest, the murder hornets, the coronavirus. There's been all kinds of crazy stuff that's happened in 2020, and I don't think anybody could have predicted this. But the good news, though, for those of you who are stressed out by that, is that there are time-tested principles that do endure over time, regardless of what the events of the day are. There are all kinds of crazy things every year, in fact. So this year seems unique, and it is unique, right? The details are unique. But if you go through any year over the last 100 years, there's been a bunch of good stuff that's happened. There's been a bunch of bad stuff that's happened too. So definitely, it's one of those things that I want to make sure people understand that we're unique in the details, but we're not unique in the sense that the world is a very uncertain place. This is not very unique in the sense that there's always uncertainty in the world. There's always risks. Some of those risks don't end up coming to fruition, right? Some of those things don't end up coming to play. There's all kinds of fears. Sometimes, like back in 2011, there was some fear that we were going to go into another financial crisis because of Europe and the high debt levels of many of the Southern European countries, which they still have very high debt levels, by the way. And over the last 100 years or so, they've had high debt levels most of the time. So there was a lot of risk involved at that time, and really a lot of fear that that would actually spread, not only that they would all go bankrupt, but that would spread, hurt the European banks, hurt the rest of the world economy, and we'd be right back into another financial crisis. So it didn't happen. But for somebody who was really banking on that fact and said, you know what, here's what I think is going to happen, I'm just going to run for the hills, put my money in cash, they would have been really, really, really disappointed because they would have missed out unless they got the timing exactly right. And of course they wouldn't, but the timing would not have been correct, and they would have missed out on one of the best bull markets of all time. So definitely something that we don't want to play with timing because it just doesn't work. At least it doesn't work consistently. Sometimes people get lucky, but luck only will last you so long. Then there actually needs to be some skill and some thought put into the strategy. So as we get going here, a couple of thoughts. First of all, Jeremy and myself, we are the wealth advisors, financial planners, financial advisors, whatever you want to call us, but we are the financial planners here at Keystone Financial Services. The key thing that you want to watch for when it comes to looking for a financial advisor is somebody who's a certified financial planner. Certainly, it means that they've got a level of experience and certification. There's also a side too, from a fiduciary standpoint, and we are fiduciaries, means that we have a legal obligation to give you advice that's in your best interest first instead of our own. And many, many financial advisors, in fact, as far as I'm concerned, I think most actually are not fiduciaries. So it's very important to look for somebody who is a fiduciary. It is acting in your best interest when you're speaking to those folks. And then, of course, the disclosure stuff, always important. That's what the attorneys wrote, but it's important to recognize that anything we talk about today is not guaranteed. It's just our opinions, really. And so take that for what it's worth. Nobody knows what's going to happen in the future. And we always want to acknowledge that, because it's not just us, it's also the top hedge fund managers, the top traders, the president, the Fed chairman. Really look at anybody in the world that supposedly would be accessing kind of secret information and so forth. Well, there is no secret information. And consistently time-tested principles, using those to actually enact your financial plans, that's the most important thing. So really, really important to recognize there's risk involved with any investment. And of course, our opinions are just our opinions. So with that in mind, I did want to kind of hit a couple of points today because we're kind of hitting the mid-year. Number one, we are doing a halftime presentation. Many of you have attended that in the past. That's one that we've done for the last 10 years or so. And we're coming up on our 10-year anniversary, in fact, for Keystone as a firm. I actually just realized this morning, I think it's almost to the day, I'm 21 years as a financial advisor when I first started. So kind of crazy how time goes so quickly. But yeah, looking at halftime report, that is coming up. It'll be in late July, early August. We don't have an exact date nailed down, but we are pulling together the material for that, and certainly want to make sure that you know that that's something that not only will be in a format like this, in webinar format, but it's something that we really pull together a lot more data. We pull together a lot more of a summary of the first half of the year. So for those of you who are attending and are looking for some more meat, that's coming. That's coming here in a few weeks when our halftime report comes out. Those are our two big ones of the year. We do our market forecast in January, typically, in our halftime in either July or August. And we will have a lot to talk about, of course. So really, as a summary for this year, we started out with a good year. Actually, it looked like the economy was going to do great. And in fact, we're going into political season. I guess we're already there, right? But a lot of times people try to attribute the health of the stock market or the economy on elections and on who's in charge, who's going to be in charge, who's going to be in charge of the Senate. Are we going to have gridlock? All those questions are being thrown around right now. And the fact remains that nobody knows. And certainly, I think even pollsters who supposedly had all the data, looking back to the 2016 election, even people with supposedly all the information don't always get it right. So I think there's a lot of time to go between now and the elections, but I think that you would probably agree with us that there's going to be a lot of uncertainty. And we definitely want to make sure that we acknowledge that uncertainty does breed a lot of market volatility. Historically, that's what happens, is uncertainty is the enemy of the market. The market, it gets very volatile, right, when there's a lot of uncertainty around policy and really on what the next few years are going to end up looking like. That's not a political statement. I think the economy can do good under either kind of administration. In fact, all three kinds, all Republican, all Democrat, or somewhere in between. We've been in a gridlock scenario for a number of years now, which really the stock market likes that in general. The stock market tends to like gridlock when there's not a party that's just dominating the other side. Requires a lot more debate. Certainly the checks and balances, we as Americans tend to like that. Sometimes it can be frustrating, which with whatever side you're on, sometimes it can be frustrating, right? If you're not able to get stuff done, and it seems like, gosh, if the party that I support would just take over all the seats, then things could be X or Y. But the reality is that the stock market actually doesn't like that. Historically, the market, and I think America as a whole, tends to like gridlock and like the fact that there's going to be checks and balances regardless of what type of environment that we're in. So a lot of uncertainty coming up as well. Certainly a lot of uncertainty around coronavirus, and really not only when's the vaccine coming, that's going to be the end game on this, is when is the vaccine coming, but really what kind of environment are we going to be in between now and then? Are there going to be shutdowns again? Are we going to go into a lockdown scenario like we were in this spring? Is that going to be more the norm, where we have rolling lockdowns and the economy starts and stops and starts and stops? I think we're in the period of figuring that out. Certainly, it depends on the area of the country. It depends on, certainly the policymakers that are in charge of those areas, and even the health experts, Dr. Fauci and others. Clearly, they don't know either, right? I think that's been one of the things that's been driving the uncertainty, is the fact that we've been looking at very, very limited data, very, very limited data, and things change very quickly. So I definitely want to make sure that that we acknowledge that those are probably the two main risks, unless the murder hornets, come back and take over or something like that. Who knows? Who knows? But the time-tested principles of financial planning really don't depend on that. They don't depend on getting it right. They don't depend on the news. They don't depend on a political party. They don't depend on things that are outside of our control. Because if they're outside of our control, then we're just victims, right? We're just victims of circumstance and kind of blowing in the wind. And I think you would agree with me that that's not a way to run your financial situation. There's a lot of things that are within our control. Certainly one of those is making sure that you've got a good financial foundation. I think all of us, it's important to look at our cash flow, look at our debt, our insurance, our cash, things that are those pillars of a financial plan, and making sure that those risk factors that could come up really are addressed by handling a lot of those proactive things that we could be doing. Not until all those things are taken care of, by the way, do we get on to investing. And investing, of course, a lot of people want to jump on to investing, the market and everything. We work with a lot of young people, not just folks that are retired, but we work with a lot of younger people that are getting started. And oftentimes that is a tendency, is, well, they want to jump right into the investments and right into the exciting stuff. But if you don't have a good foundation, it's kind of like the three little pigs. If you remember that nursery rhyme, the three little pigs, well, which house stood? It was the one that was stone, right? Because they had a good foundation. The other two pigs lost their homes, and so we want to be like the pig with the brick house or the stone house. What was it, Jeremy? I can't remember.
The brick house, I believe.
Brick
Yeah.
house. Yeah, the brick house. So that's like having a good financial plan and having something that was well thought out versus just kind of winging it. And unfortunately, most people, my circumstance, at least my opinion from the number of conversations I've had with people over the years, is that most people are kind of winging it. They're kind of winging their financial planning, and that means that they're leaving a lot to chance. And a lot of people end up being very disappointed. And probably one of the comments that Jeremy and I hear the most actually from folks is, I wish I would have started sooner. I wish I would have started sooner. I wish I would have started paying my debt off sooner. I wish I wouldn't have spent money on X or Y. I wish I would have started investing when I first got out of college, or maybe even before, right, when they were in school. So that's one thing to recognize, is that you've got plenty of company if you feel that way. I think all of us, think that some variation of that, right? That we wish we would have taken the money that we had blown on something stupid when we were young, right, and bought stock with it or something like that. So yeah, just recognize that you've probably got plenty of company, and we do want to make sure that there's a good financial foundation before we jump onto investing. And investing is important. Certainly, that's the engine that's going to be growing our wealth over time, but that really comes second. There's a lot of investment opportunities right now. That's one thing that the uncertainty has generated, is that we've actually have a lot of investment opportunities, a lot of cheap stuff out there right now. Even though the market has rallied off of some of its lowest points, there still are some decent deals. The market certainly is cheaper now than it was before things started pulling back. And the method that Jeremy and I both like to talk to folks about is dollar cost averaging, as far as putting money in gradually and in some kind of a schedule into the market, as opposed to trying to get lucky. And again, not as exciting. It's not as exciting maybe as watching CNBC every day and rapid trading, that sort of thing. We've never met anybody who can do that consistently and produce any better results than somebody who follows more of a boring strategy based on principles. So we do like dollar cost averaging. If you are employed right now, you probably are adding to a 401k, stock purchase plan, something like that. If you're not employed, maybe you're self-employed, maybe you are participating in your own retirement plan, or maybe just your own investment plan, you can set it up automatically. The banks are well equipped to be able to do that these days. So we do recommend that people get on a schedule, pick a dollar amount, ideally pick a percentage of your income, and that's what you end up putting away over time. You might remember that the percentage that you should be putting away we have to be careful with that word, because it could be a little bit um, like kind of like beating ourselves up, right? But the percentage historically that financial planners talked about is somewhere between 10 to 12% of our income that we should be putting away for the long term, for the long run, to build up enough wealth to be able to retire on and be comfortable. I would debate that a little bit now, especially the younger that you are. You may actually want to reconsider that and raise that percentage up, because the 10 to 12% number, that actually was a principle that was being thrown around back when people had company pensions and Social Security was a thing. So really, people had maybe had a lot of certainty from other sources of income they'd be bringing in. Now, I think you'd agree with me that Social Security is not on the firmest foundation it's ever been on. And again, is it within our control or without our control? It's not in our control. So if the government decides to change the rules, if they change the age, they change the dollar amounts, I think you probably would agree, regardless of your political affiliation, that the government is not very good at handling money and not very good at following through on promises, not just at the federal level, but sometimes at the local and state level as well. So I definitely would not be putting my a huge amount of faith anyway into Social Security. And again, company pensions, how many people have those anymore? Not very many, unless you work for the government. Government entities are about the only place that you could get a guaranteed pension anymore. There are a few companies, but it's not many. Most companies have gotten rid of their company pensions. They've frozen them or gotten rid of them. So it might be something that you remember, maybe one of your parents or relatives or somebody, that was a big part of their retirement income. You probably don't have that. If you're on this podcast, you probably don't have that. It's probably something that you're completely relying on your investments, your savings, to be able to fund your retirement. Therefore, a number that we've been throwing around a lot more is in the 15 to 20% range. That percentage needs to go up, because you're going to need to do a lot more of the heavy lifting yourself. So will Jeremy and I. We're all in the same boat. So definitely something to take a look at as far as how much percentage you're putting away. But with that, any questions that have come in so far, Jeremy, that we need to hit, or others that
We do not have any live questions as of yet, Josh, but maybe you can talk about, I know there's a lot of chat about a second stimulus coming
Oh, yeah.
year, and what the likelihood of that you think might be.
Yeah, well, again, my opinion, but I think it's pretty likely. You've got a lot of people that are very motivated to get reelected right now. So that's always a popular way to get reelected, is to show your constituents that you just gave them a bunch of money. You might, excuse me.
Yeah, and I think you're right on the money there, Josh. It's not so much an economic thing, I think, right now, as it is more of a politically driven thing.
Yeah.
Mostly because 2020 is an election year, and I think we're going to start to see that playing out a lot more in probably the second half of the year.
Yeah, for sure. There's probably going to be something. I think they all have some incentive of coming up with some kind of a bipartisan plan, because they all want to be able to go back and say they did something, versus being labeled as somebody who obstructed, some money that needed to be pumped into the economy. I also think that it's getting more and more likely that it's going to happen, simply because if we are going to be in the midst of these rolling shutdowns, where segments of the economy kind of start, stop, start, stop. We were kind of working off of the assumption back in the spring that, hey, there's going to be these trillions of dollars that the government's going to inject into the economy. We're going to do this for a couple months and we're going to flatten the curve and then we're good. The healthcare system didn't get overwhelmed and away we go. That's not the way that it's played out. And again, we could get into a big debate about right, wrong, or indifferent how policymakers are handling this, but that's not the way it's being handled. And it does look like we're going to be in various stages of businesses being shut down or being at least way throttled back. Think of Disney World, for example. They've
Mhm.
been shut down for months now, and movie theaters, things like that, right? All these things have been shut down effectively. And Disney World was supposed to open on July 11th. I don't know that's going to happen at this point with some of the virus stuff surging. I don't think they've announced anything yet. But you think about that. Of course, Disney is a more diversified company, but you think about where do they get all their revenue from? A pretty good portion of it is from merchandising and parks and releases of movies. Mulan, for example, it was supposed to come out, I think, this summer, and now they've delayed it. It's a lot of money. It's hundreds of millions of dollars, right? That they're not going to be able to realize unless people can go in large numbers to the theaters. So you're looking at businesses like Disney. Think of any other business. There are a few that aren't being impacted and some are being positively impacted by this, but most businesses to some degree have really been throttled back. It also could increase the risk, and this is where there's debate about, is the stimulus for businesses, is it for individuals, is it both? Is with an elevated unemployment level, how long will it be, until consumers start having major problems and you see foreclosures and so forth really spike up? It could end up being a much, much longer recession, even though our purpose behind all of this has been noble, to save lives. Certainly, there's a huge, huge economic impact, and traditionally, when we go into a recession, the government steps in to some degree and pumps money in. They end up being that stopgap until things kind of get going on their own again.
Mhm. Then the other flip side of that too, just as you mentioned, is unemployment. And so maybe you can talk about how, um, we've had conversations with clients about how this unemployment situation is kind of different, largely in part because of the unemployment, I guess, kind of stimulus that the government has put in there. And so we do see a lot of people who technically are unemployed, but anymore it's almost because of choice, because quite honestly, they're making more on unemployment than they were actually in their job. And so,
Yeah.
what do you think is the likelihood of the government extending those unemployment benefits specifically for COVID? Or do you think they want to kind of cut that out and get people back to work, give them more incentive?
Yeah, and that's what we've been seeing in some of the proposals, is that there would be money for individuals, but it would be more of an incentive to go back to work type of benefit. And because right now that is true, actually, they've got some data on this, that there are a fair number of people that are getting more money than if they went back to work. So they say, well, why should I go back to work? Even though there may be some jobs out there. So one thing to think about is how do we get people back to work and get them back to work in a way that it doesn't negatively impact the economy. In other words, where they still have enough cash in their pockets to be able to go spend it, because 70% of the economy is just us spending money, just us as individuals spending money as consumers. If you kind of track it long term, now the other third, of course, that's the government and business, and the government has stepped in and spending more money right now than it normally would be to pump the money back into the pockets of the businesses and consumers. So that doesn't work forever. The government can do that for a while, but right now that's what it's looking like, is that there may be some kind of an incentive that would get people back to work, that would help get the unemployment numbers down. Percentage wise, the unemployment rate is probably a lot higher than what it needs to be, simply because many of those folks they don't have a financial incentive to go back to work based off of the current benefits that they're receiving.
Yep, absolutely. I couldn't agree more. So yeah, that'll be a kind of interesting one. I know that one's going through a lot of talk about all that stuff, but we'll just have to wait and see because our crystal ball is broken, right?
It is. It is. Yeah. And right now, especially with politics, I know that's on a lot of people's minds right now, is how are the elections going to affect the markets and the economy? That's been a question that we've gotten a lot. And it's legitimate, right? Because policymakers do actually have a huge impact on the economy. They certainly have a impact on taxation and on incentives for businesses and individuals. So a lot of that may change, especially if there was a big sweep to the left or a big sweep to the right. Right now it looks more like a sweep to the left as of today. Now, things can change really quickly. And certainly if you had asked people back in January, February, they wouldn't have predicted that. At least the pollsters are predicting that right now, whether they're right or not. So that's what they're predicting. And certainly that means a lot of policy change is potentially there. It probably would see a lot of policy change as of a new administration. So that does give a lot of uncertainty, and that's why the market doesn't like one party dominating and having one party be in charge of all the houses, or both houses and of the presidency, because it means a lot more uncertainty versus if we kind of go as we have been, right, without any big changes. Businesses and individuals kind of know the rules of the game, and they know that they're probably not going to dramatically change.
Yep.
Yeah. What else?
No
Any other?
other actual live questions right now, Josh. So.
Yeah. Yeah, and that's fine. And of course, you can always email us after the fact to Jeremy at KeystoneFinancial.com, Josh at KeystoneFinancial.com. Certainly, we want to be here as a resource through this. We've had a lot of uncertainty this year, and I don't think that's going to change. I think the rest of the year is going to be a lot of uncertainty. The market is going to reflect that, in my opinion. I think the market's going to stay very volatile. You're going to see a lot of swings in price. Certainly, there could be a lot of downside surprises that come along the way. We hope that this is a V-shaped recovery. We're very much hoping that this is a V-shaped recovery. The economy recovers quickly. The unemployment rate goes down dramatically over the next 12 months, and then we've got a vaccine quickly. Certainly that's what we're hoping for, but a financial plan is not built on hope. So certainly I would not take that as a timing statement that you should take all your money and be really aggressive with it or something like that. But we do like the fact, though, that the market's bounced off of its lowest points. We're much, much higher than we were back in March, April. And certainly, I think there are some bets that investors are making that things are going to improve, that the economic situation is going to improve. It's just a matter of how fast is it going to take until things get back to normal. I would debate and say that it's probably not good to go back to exactly how things were, because we've figured some stuff out too, right? Businesses have figured out more efficient ways to work. Many of you have probably figured out that you can get things done more productively at home, even working from home. And many businesses are certainly dropping their real estate and say, you know what, we don't need that anymore. So that's one thing that recessions always do, is they do tend to make things more efficient. So certainly, I think us as individuals and businesses can take that and certainly make adjustments that we can carry forward. So with that, I certainly hope you all have a great 4th of July. If there's anything that we can do for you, your coworkers, family members, if there's any topics that you'd like us to hit in any format, sometimes we take stuff and use it in different places, like the podcast is coming out soon, also webinar topics and articles. So certainly let us know about that. Otherwise, I hope you have a great 4th. If there's anything that we can do for you, just let us know, and have a wonderful weekend. Take care.
Take care.